$706,877. The portfolio jumped $64,000 this week, a 10% move in 5 trading days. Here is how that breaks down. Marathon Digital stock rebounded from $967 to $1155, adding roughly $87,000 in unrealized equity on our 46,000 share position. That gain was partly offset by $34,000 in drag from an ETHA Leaps unwind and some SPY repositioning. And the wheel itself quietly printed another $11,000 in net option premium. Welcome back to the lab. This is Trade of the Week, Episode 2, and today we break down our first poor man's covered call. The wheel kept printing this week. 46,000 shares of Marathon Digital produced $11,939 in net premium across 170 short puts and 465 short calls. Coinbase added $222 on 2 covered calls at the 220 strike. Bitmain Immersion chipped in $116 on 4 calls at 30. The MSFT wheel is the engine. Coinbase and Bitmain are the side hustles. 3 positions, 3 income streams, 0 drama this week. Here is what that wheel activity actually looked like. On April 14th, MARA rallied through $11, which pushed several of our short calls deep into the money. We rolled them up and out. Closed 65 contracts of the April 24th 10.5 strike, paying $5,100 to buy them back at a $4,000 realized loss. Opened 65 new contracts at the May 15th 11 strike for $6,800 credit. Net credit $1,700. Short strike moved up 50 cents. Duration extended 3 weeks. This is active wheel management when the stock moves against your short calls. SPY had the most activity this week, and it is 2 separate strategies running in parallel, which is why it is laid out in 2 sections. Top section, the PMCC side. We sold back the September 650 leaps for $7,500, locking in $1,500 of profit on the long leg. Then rolled 3 short calls, paying to close 2 losers at the 706.85 strikes. Opened a new short at the 705 strike for $1,300 credit. Bottom section, a front put spread. 2 short 671 puts for $858 credit. 1 long 686 put for $677 debit. Net credit $181. Defined risk, bullish to neutral structure. But the real story is not the wheel or the SPY rebalance. We opened a trade on Microsoft that could pay for itself. It is called a poor man's covered call, a PMCC, and it is one of the most capital-efficient structures in the entire options playbook. Let me walk you through exactly what we bought, exactly why we bought it, and exactly how we plan to manage it. By the end of this breakdown, you will understand the structure well enough to size one yourself. A poor man's covered call is a covered call without the 100 shares. Instead of buying 100 shares of Microsoft at $44,000, you buy 1 deep in the money long-dated call. That long call acts like synthetic stock. Then you sell a short-dated call against it, collecting premium every month. Same payoff shape as a covered call. A fraction of the capital. The trade-off is that your long leg has an expiration date, so you have to manage it, and Microsoft has to stay above your long strike for the structure to hold its value. Here is the ticket. On April 14th, we bought 1 Microsoft June 2027 360 strike call for $79.05. That is a debit of $7,905. The same day, we sold 1 Microsoft May 8th for 140 strike call for $3.10, collecting $310. Net opening debit, $7,595. 2 legs, 1 long-dated anchor, 1 short-dated income generator. That is the entire trade. The long leg math and the timing. Microsoft is trading near $440, so our 360 strike call is $80 in the money. Of the $79 we paid, roughly $80 is intrinsic and the remainder is a sliver of time premium. That thin extrinsic is the door implied volatility opened for us this week. Microsoft just reported earnings. For compressed, the market stopped charging a fear premium on leaps, and this was our entry. Functionally, this deep in the money leaps behaves almost identically to owning 100 shares. Delta is north of 90. It moves dollar for dollar with Microsoft. The short leg is the income engine. $310 collected against a 440 strike call expiring May 8th. That is roughly 3 weeks of theta decay working in our favor. Annualize that credit over 12 monthly cycles, and you are looking at $3,700 of potential premium against a $7,600 capital outlay. That is a theoretical 48% annual yield on the debit, assuming we can keep selling at similar credits every month. The short leg is where PMCC earns its keep. 3 scenarios at May expiration. Scenario 1. Microsoft finishes below 440. Short call expires worthless. We keep the full $310 and sell another one in June. Scenario 2. Microsoft finishes between 437 and 440. Break-even zone. The cycle is roughly flat. Scenario 3. Microsoft closes above 440 and gets assigned. Our 360 long covers the assignment. We capture $80 per contract of intrinsic spread, or $8,000, minus the $75.95 net debit. That is roughly $400 of net profit in the first month, plus we still own the long leaps. Risk scenarios. Microsoft flat at 440, best case. Short call decays to 0, and we keep the full 310 credit. Microsoft up 10% to 484. The long leaps gains more than the short call loses because the long delta is higher. We come out net positive on the cycle. Microsoft down 15% to 374. Both legs lose value, but the long leg still retains $14 of intrinsic down to 360. The true disaster is Microsoft crashing below 360 and staying there through June 2027. That would zero the entire $75.95 debit. Capital efficiency is the real magic. 100 shares of Microsoft at $440 costs $44,000. Our PMCC costs $7,595. That is roughly 17% of the capital for substantially similar upside exposure up to the short strike. The freed up $36,000 in capital can fund 5 more PMCC positions across different names or stay in the wheel earning premium on Marathon Digital. This is how a retail portfolio compounds, not by concentrating in shares, but by structuring exposure so every dollar is working in 2 places at once. For takeaways and one management note. 1. PMCC replaces 100 shares with a deep in the money leaps, cutting capital needs by roughly 80%. 2. The short call is the income engine. Sell it every month. 3. Enter after implied volatility compresses, typically post-earnings. 4. Never let the underlying close below your long strike at leaps expiration. That is the one scenario that zeros the trade. Management plan. Roll the short every month as expiry approaches. Close the long leaps around 90 days before its own expiration to avoid theta acceleration. Structure beats prediction. Every time. $706,877. Up $64,000 this week. Almost 10%. $11,000 of that came from pure wool premium, the rest from Mara stock recovering. The Microsoft PMCC is our first asymmetric long position funded from that premium stream. $75.95 of capital deployed into a structure that could generate $3,700 in annualized income while maintaining upside exposure to a mega-cap tech leader. If you want to see how the rest of the portfolio evolves, how we stack the next PMCC, when we roll, when we close, subscribe. We publish every trade, every week, with the real numbers attached. That is the trade. Microsoft PMCC, 1 long leaps, 1 short call, $7,500 of capital doing the work of $50,000. Structure over prediction, math over hope, and a portfolio that compounds because every dollar is placed with intent. Next week we are back with the portfolio update, the wheel roll, and the next trade ticket. Bring a notebook, bring your own numbers, and run the math alongside us. Until then, stop guessing. Start calculating. This is mathematical money.